Hey everybody, it's Matt Bowles from Maverick Investor Group. I am super excited to have everybody here tonight for this event. We are probably going to go maybe 45 minutes or so and then take your questions at the end of this webinar. So about an hour maybe. This is 100% live. We're super excited to interact with you during the webinar and do your Q&A and all that kind of stuff. Let's just check out the chat box though, because this is how you're going to communicate with us. On the right-hand side of your screen, go ahead and type into that chat box. Let me know where you're tuning in from tonight. I see Imran has already typed in there. Hello, good to see you. Anybody else, as you're coming on here, just type into the chat box. Let us know where you're tuning in from tonight. And let me know if this is your first ever Maverick webinar or if you've been with us before. For everybody that might be new to this, we are super excited to have you. Maverick Investor Group, the company that I own and have been running for 19 years, we help you to buy turnkey rental properties in the most investor-advantaged U.S. real estate markets, regardless of where you happen to live. So brand new construction or fully renovated properties with tenants and local property management already in place. And we help you to build your portfolio over time and build your wealth that way. And that's what we've been doing for 19 straight years. A lot of our clients have been buying with us for over a decade, still building their portfolios today, diversifying across markets and all of that. And one of the other things that we like to do is to bring you other industry experts that have knowledge and services that can help you in your real estate investing journey. And so that is what we are here to do tonight. We have an incredible educational resource webinar for you tonight. I am super excited to welcome and introduce you to MC Laubscher. He has been personally investing in real estate since 2001. He is a best-selling author of multiple books. He's the host of the top-rated Cashflow Ninja podcast. He is also the founder of Producers Wealth, a firm that helps business owners implement and execute advanced alternative wealth strategies. He is a member of the Forbes Finance Council and the $1 Million Roundtable, a peer group for the top 1% of financial professionals worldwide. And tonight, he is here to talk to you about the system for scaling your rental property portfolio. So with that, I am going to turn it over. MC, welcome to the Maverick community. Welcome to the webinar.
Thank you so much for having me, Matt. I've been looking forward to this. I'm ready to rock and have a lot of fun with everybody. If you have questions as I'm going through this, please put it in the chat so I'll make sure to answer your questions at the end of this presentation. You know, I just wanted to share, Matt alluded to that I started as a real estate investor in 2001. So I was playing sports, traveling quite a bit, and came across a purple book called Rich Dad, Poor Dad from Mr. Robert Kiyosaki. That little purple book has converted a lot of people to the world of real estate investing and alternative assets. But when I read that book, and I'm an action taker, so 6 months into it, I bought my first property, single family, and I still remember the day. You know, I put some tenants in it. I collected the rent. I paid all of the I paid all of the bills associated with the property, and at the end of the day, there was cash flow. Cash flow, just like in the book. It's easy, man. It's easy. It was a lot of fun, a big light bulb moment for me. And then, of course, school starts. And I always, you know, as I was trying to grow my real estate business, ran into, I call it now, structural issues, because I wanted to scale my business, and you're here because you want to learn how to scale your rental real estate property portfolio too. And, you know, I run into structural issues. And what I mean is, you know, you could have, let's just say you have 2 to 3 properties, to make this just relatable, because that's exactly where I started to run into these issues, believe it or not. Some people run into them at 10, 15, 20. 20 something, what's it now, 26 years ago? It's crazy. 25, 26 years ago, it was like 2 or 3 for me. But what started to happen is, let's just say you have 3, one tenant stopped paying, something breaks in the other one. And I fully embraced this mantra that Robert Kiyosaki taught in the Rich Dad, Poor Dad book, the cash is trash, right? But it's not if you need it, because at that stage, I always got stuck because I didn't have liquidity and a structure, an infrastructure to facilitate the scaling of my real estate rental portfolio. So I'm going to share a couple of things with you tonight. As I discovered on my journey, this actually happened. I was introduced to someone in my network, and they really, really blew my mind because they said, "Look, MC, it's very simple." And this was a very wealthy family, family office style type of family and individual. They were one of the largest real estate investors on the north side of the city of Chicago. And he would say, "We keep things very simple. We make money in our family business. We position it according to this structure, which I'm going to share with you guys. And then we leverage that to buy more real estate. And we just do it over and over and over. And we never have a problem with liquidity in order to scale." So tonight, I'm going to share the system for scaling your rental property portfolio, how single family investors use a personal bank to buy more homes faster without running out of cash or waiting on traditional lenders. All right.
Take it away.
There we go. The hidden bottleneck in single family investing. You know, it's interesting. We could talk about a lot of bottlenecks that we have and the challenges that we face in trying to build and scale a portfolio. And most people, if I have to ask you, what's your single biggest problem in scaling it? The first place that they go to, well, is it finding properties? And we know that's not it because you're on a Maverick webinar. So that's not the issue. It's not. The real constraint isn't deal flow. You have resources, just as Maverick, that provides constant deal flow of fantastic properties in some of the best markets in the United States. It's something far more critical that determines your scale, your scalability, right? And you can either scale or stall. And that's, you run out of liquidity. You run out of cash. You don't run out of deals. You run out of liquidity. So this is the fundamental truth that separates investors who build portfolios from those who get stuck after their first few properties. Just like I did. I know. I can feel the pain because I was there. So understanding this distinction changes everything about how you approach the growth and the scalability of your real estate rental portfolio. So why capital constraints kill portfolio growth? And this is what we're talking about. Liquidity, cash, capital, all the same thing. Down payments stall growth. Every property requires 20 to 25% down, locking up significant capital that could fuel multiple acquisitions. Your expansion stops when the cash runs dry. Cash sits idle between deals. So capital deployed in properties generates returns, but money waiting for the next opportunity produces nothing. It's just sitting there. So dead periods erode your overall rate on return, right? So equity gets trapped. As properties appreciate, your equity grows, but it's inaccessible. Wealth on paper doesn't buy you the next rental. It's great for cocktail party conversation, but it doesn't get you the next one. This illiquidity becomes your ceiling. Banks control your pace. Boy, how much fun is banks to deal with? Traditional financing determines your velocity. Loan limits, approval timelines, and qualification requirements dictate when and if you can grow. You're building on someone else's schedule. Yeah, anybody that had to deal with a bank understands that you're getting a proctology exam every single time. So single family investing doesn't fail because of bad properties. It fails because capital gets stuck in a system that is designed to limit your momentum. All right, the traditional investor trap. So does this sound familiar? Where capital goes to die. So you have the cash, you use it for a down payment, and now the cash is gone. You're back to zero. Your liquid capital disappears into closing costs and equity you cannot access. All right, equity, a liquid asset. Property appreciation builds wealth you can't deploy without selling or refinancing. HELOCs, home equity line of credits. It depends on a bank approval, right? And risk. It becomes risky in a volatile interest rate environment. By the way, this used to be a pretty nice strategy when interest rates were almost at zero, right? But the interest rate environment has changed quite a bit. So home equity lines require credit checks, income verification, come with that very ugly term that we've come to know, variable rates. So cash reserves can also be seen as dead money, emergency funds just sitting and earning minimal interest while inflation erodes their purchasing power. And that's the trap that I fell into because, Robert Kiyosaki at that stage was saying with Rich Dad, Poor Dad, cash is trash. You got to just roll it into the next deal and roll it into the next deal. And that's why if you don't know what other options are available to actually turn those cash reserves into compounding, a pool of compounding growth and uninterrupted, which I will share, instead of dead money. So traditional investing turns cash into concrete and hopes nothing breaks. All right, stop being a borrower, start being the bank. Every great real estate investor has a bank. The question is, who owns it? It's interesting. The banking system is incredible. Banks are actually, if you look at the business model, it's actually impressive. It's incredible. Think about it this way. If you go to a bank and you deposit money into that bank, whether you save it, you spend it, or you invest it, the bank makes money in every transaction. Go to that same bank and get a loan, borrow some money. And regardless of what you do with that money, whether you save it, whether you spend it, or whether you invest it, the bank makes money. The bank makes money regardless of what the transaction is. Pretty incredible business model. So the banks makes the profit, and the shareholders of the bank, well, they own it, right? So they make the money. This is where infinite banking, and let me know in the chat if you've heard of infinite banking. There's a lot of information these days out there. When I started 25, 26 years ago, and started actually implementing infinite banking. It's almost 20 years now. There wasn't a lot of information known about it, so I'm going to share a little bit about it. But essentially what infinite banking is you use the asset clause of life insurance. And I know this is when you're going to get eye rolls. If you have a different lens and if you look at investing through the eyes of, let's just say, a family office family, you have a different money lens, you have a different mindset, and you have a different approach, and you actually see it as an asset clause, not an expense. And what infinite banking is you use a very specific and a specialized type of life insurance. It's a dividend-paying whole life insurance policy with a mutual life insurance carrier designed for early max cash value. So most people think life insurance, well, somebody else has to die in order for someone else to benefit. There are massive living benefits. And this is actually where the ultra wealthy and ultra affluent, this is where they store their capital. These are capital engines for family offices. This is where they position it. I alluded to my friend that came from a very wealthy family that shared this concept with me. He said, MC, we make our money in our family business. We park it all in life insurance, these specifically designed life insurance policies, and we leverage it to buy real estate. Why would you use this specifically designed life insurance policy to warehouse cash as a capital engine? Well, number one, it's designed for early high cash value. So the majority of the premiums, 70, 80% of it goes straight towards the savings element, the supercharged savings account. The money is guaranteed. It's guaranteed to grow because you're setting it up with a mutual life insurance company, which the policyholders are the shareholders. You get to benefit from and participate in the profitability of the company. So you get some profit sharing, and that's dividends. You get paid a dividends, which is also it's also tax-free. So the growth in the policy is tax-free. Through proper strategies, you'll never pay taxes on the money that's inside of the policies again. It also has asset protection in all 50 states, some more than other. You know what states, I don't need to point them out for you to pick on that is not very, very favorable towards landlords. Kind of the same situation here. But anyway, asset protection in 50 states, it's money off grid, it's private, it's a private contract, so nobody knows that you have it unless you tell them or disclose it. This is all great stuff because in an event of a lawsuit, if a tenant sues you, for example, yes, you have other structures in place, but they cannot get to this. It also has other riders that you can add to it, such as disability riders, long-term care riders. Not that it should be your long-term care plan, but it's great to have that. Anyway, so what does this provide? How do we use this as real estate investors? Well, we combine these two asset classes to create an infrastructure and build out a capital engine for you to grow and scale your portfolio. So reframe for real estate, infinite banking. It provides private liquidity on demand. You can access capital immediately without applications, credit checks, or approval delays. Your money moves at the speed of opportunity. Guaranteed growth on idle capital. Every dollar compounds continuously with contractual guarantees, ensuring your reserves never lose ground to inflation. And you have full control of financing decisions. Set your own terms, repayment schedules, loan amounts. No banker telling you when, where, or how much you can borrow. So here's a critical distinction. This is not an investment. Nobody should talk about the asset clause of life insurance as an investment. It's a savings vehicle. This is a capital engine, and this is real estate infrastructure, the financial foundation that makes everything else possible. So I just wanted to also share dividends right now at the time of recording. We're in early 2026. It's about 6% that you're getting inside of the policy. Borrowing rights, that's how you access capital from this life insurance policy, is through a policy loan. Borrowing rights are around 5%. So how it works is you place the cash value of your policy as collateral for a loan, and you have guaranteed access to that policy loan. It's in the contract that you have with the insurance company. So it's very similar to a HELOC, which uses the equity buildup in the property as collateral, but you have to go through the bank and that whole approval process. Where with the life insurance, you have guaranteed access. It's through the policy loan. It is in the contract. Why? You've already given them your cash value, and there's a death benefit, so they have two pieces of collateral. And that's why rates are so low compared to HELOCs too. All right, the role of your real estate bank, which this becomes this policy or of a combination of policies, if you decide to do it that way for your family, actually this becomes your personal real estate bank. So your infinite banking policy becomes a central hub for every aspect of your single family portfolio. Down payment fund, deploying capital instantly for property acquisitions without depleting other reserves or waiting on wire transfers. So you need a down payment for your next property, boom, it's right there in your infinite banking policy. Opportunity fund, maintain liquidity capital ready to pounce on undervalued properties, distressed sales, or off-market deals that require fast action. So you're building up this war chest to capitalize on opportunities as it presents itself. Who gets to capitalize on opportunities? Well, it usually is the person or persons that can operate and execute on speed, right? Speed to the deal gets the deal done. Emergency maintenance and reserve. So this is where I ran into issues with scaling years ago. Cover unexpected repairs, tenant vacancies, or property emergencies without touching operating cash or selling assets. So I thought cash was trash. So I always try to roll it into the next property. And guess what? When I had tenant vacancies or I had to do repairs, where do I go? Not even a bank. It gets worse. credit cards. Talking 25, 26 years ago. So lessons learned, I guess, when I was younger, right? So you can also use the policy for tax and insurance reserves. So pre-fund annual obligations in a growth environment instead of letting money sit idle in an escrow account. Yeah, what does that do for you, by the way? I've always wondered. You know, you're putting money in an escrow account that funds the taxes and even, let's just say, the insurance, and you're not benefiting at all from that transaction. You just write the check. It's gone. It's left your pool of money. How about you keep it in your own pool of money in your policy, let it work for you, compounding, growing tax-free, and when the taxes are due and the insurance payments due, well, it's there. Acquisition capital build a scalable war chest that grows larger with each successful deal, compounding your buying power over time. So instead of having your money sit in 5 different places earning nothing, it lives in one centralized capital hub working multiple jobs simultaneously. So that's the big takeaway here. It's now your capital engine. It's at the center of everything that you're doing, this policy. How it works in practice. So this is where theory meets reality. So I'm going to share this strategy that transforms every dollar into a multitasking powerhouse, simultaneously building wealth across multiple channels while maintaining complete liquidity and control. You want to have control over this entire process. And yes, that's the big thing. We've all heard this saying, well, I want my money working for me, right? Again, rich dad, poor dad. Don't work for money, let your money work for you. Fantastic. But how about we work that money as hard as we possibly can and we make it work in many different areas simultaneously? So think about how many dollars you have right now sitting somewhere for you doing one job. Where in an inflationary environment, which we all live in the West, you need to do multiple jobs simultaneously. All right. The multiple job dollar, $1, multiple jobs at the same time. So most investors think they have to choose, put money in real estate or keep it liquid, buy cash or finance, build equity or maintain reserves. But what if your capital could do all these things simultaneously? That's the breakthrough concept behind this personal real estate bank, this infinite banking policy. A dollar that never stops working, never sits idle, and compounds value in multiple directions at once. All right. Here's your dollars for simultaneous jobs. When you position it, you fund the policy, you set the policy up. Your capital grows tax deferred inside the whole life insurance policy, compounding steadily and predictably year after year. This growth is contractually guaranteed, creating a rising floor of wealth that never goes backward. And if you have a proper strategy, you never pay taxes on the money in the policy. Then you use it for rental property acquisition. So you borrow against your policy to fund down payments on investment properties. So you don't access the money, you don't draw it down. You use the cash value as collateral and you borrow against it. The same way that you would borrow against your home equity through a HELOC or asset-based lending like Elon Musk loves to do with his Tesla stock portfolio. Some folks even do it with gold, silver, and artwork. Some folks even do it with crypto. Same concept. You borrow against it. It's an asset. Your collateral remains intact and continues growing while you deploy capital into appreciating real estate assets. Monthly cash flow. Your rental properties generate consistent monthly income streams. This cash flow can serve as your policy loans, fund additional investments, or cover living expenses, creating financial flexibility and freedom. And then, of course, emergency reserves. Your policy cash value remains accessible for emergencies, opportunities, or unexpected expenses. Unlike equity locked in real estate, this liquidity gives you the confidence to act decisively when markets shift. So this is in theory. This is practical wealth engineering. This is how banks operate. This is how insurance companies operate. This is how the ultra-affluent families operate within family offices. Each job reinforces the others, creating a compounding effect that Traditional strategies just cannot match it. So again, we didn't even talk about the tax benefits. It's another job. The death benefit of the policy. Another, I mean, we could go on and on about how many different things $1 actually does for you in this infrastructure that I'm sharing. The wealth multiplication effect. So the traditional approach is, say, $50,000 in a bank account earning 0.5% interest. Use the entire $50,000 for a property down payment. And then the result is zero liquidity, one asset, one single growth factor. So your capital is now locked up in the property, need cash, sell or refinance. Want another property, start saving from scratch. The personal bank approach, using this infinite banking strategy, fund your policy with $50,000, growing at 4 to 5% tax deferred and also tax free eventually if you have the right strategy. Borrow $45,000 for the down payment while the $50,000 keeps growing. The result is fully liquidity maintained, two appreciating assets, multiple income streams. Your capital continues compounding in the policy, rental income, services alone. Need more capital? Access it immediately. Ready for property number two? Your bank is ready. So the mathematical advantage compounds over time. After 10 years, the gap between these approaches can represent hundreds of thousands of dollars in wealth differential. All right, let's talk about building your personal real estate bank. Creating your personal real estate bank isn't a one-size-fits-all template. It's a custom-engineered system designed around your specific situation, goals, and timeline. Each situation is different, by the way. We have at Producers Wealth have worked with over 500 families in all 50 states, and I could tell you there are very few situations that are the same. It's all different, but it's the same concept, the same strategy. It just has a little bit of moving different pieces. All right. So the 4 pillars, we talked about the down payment strategy. So we engineer your policy funding to align with your real estate acquisition timeline, whether you're planning your first rental purchase in 12 months or building toward a portfolio over 5 years, that your capital accumulation matches your deployment schedule. So there's a down payment strategy that you look at. So we analyze your cash flow, determining optimal premium structures and timing policy loans to coincide with property opportunities. Capital stacking plan is the second pillar. Your wealth architecture layers multiple capital sources for maximum efficiency. Policy loans provide the foundation, but we integrate traditional financing, seller financing, partnerships, and equity position to optimize leverage ratios and minimize cash drag. Each layer serves a specific purpose in your overall strategy. So you can take the down payment from your policy and then combine it with a bank loan. So we're not throwing that completely out the window here. We're just doing it in a more optimized way to help you grow and scale your portfolio faster. The third pillar is policy design for investors. Not all whole life policies are created equal for real estate investing. We structure policies with high early cash value, minimal commission drag, paid up additions riders, and optimal loan provisions. This design prioritizes capital access and growth over death benefit. So you're more focused on turning this into a supercharged savings account than just a very expensive policy with a death benefit. So you want to create a true banking system, not just insurance coverage. Remember, we're using the asset clause of insurance to accomplish this. Real estate integration. So your policy becomes a central hub of your investment ecosystem. We map out property acquisition sequences, cash flow allocation strategies, loan repayment schedules, and portfolio expansion timelines. So the goal is to create a self-sustaining system where rental income recycles back into your bank, funding future acquisitions without additional out-of-pocket capital. I want to share something with you. This is interesting. And this person was a mentor of mine, I would say around 2001. Before I met my wealthy friend that shared this strategy with me. This person, I met him at a meetup. This is, fun fact, not to get off topic, but this is hilarious now that I think about it. I used to find real estate meetups in like the free newspapers at like 7-Elevens and stuff. It's like, before the meetup.coms rolled out. But anyway, there's always incredible people at real estate meetups. There's always older, more experienced people that want to help you. So I met this gentleman, older gentleman. He looked at me. I was just a young puppy, just chomping at the bit, ready to take on the world. So he spent some time with me, and he told me that, he said, hey, MC, in the 70s, we used to actually leverage CDs. So they would go to a bank, let's just say I have $100,000. They would put it in a CD in a bank because it was paying like 10+%, right? We're talking, this is like very high inflation times. And then he said, at MC, I would go back to that same bank and say, Mr. or Mrs. Banker, we have a $100,000 CD that's locked in for 12 months, earning, 10, 11, 12%. Can I get a loan secured by that CD from you? And what did the banker say? Oh, yeah, absolutely. Because that's part of the model, right? Taking in deposits and issuing loans. So he would get like a loan, 90% of the value of the CD at like 8-9% at a lower rate. Why? Because they have his money. So the risk is lower. Lower the risk, lower the interest rate. So anyway, he would then go buy real estate with it and then pay back the loan to the bank. And this is, you keep getting that 10% just every single year in the CD. You have the loan, which you use to buy the real estate, right? This strategy, infinite banking, puts rocket fuel on that because, again, it's tax-deferred and tax-free growth that you have instead of paying taxes on that 10% he was getting every year. You also have a death benefit. You have disability riders, long-term care riders, and so forth on it. You get to access money very, very quickly, too, by borrowing against the cash value in your life insurance policy. And again, you set the repayment schedule, and it's a revolving line. This is where it gets better. He had to pay back his whole loan before he could get another loan. We have a revolving line of credit. So as soon as you pay it back, guess what? Boom, it becomes available again. You take $50,000 for, let's just say, down payment on 2 properties. You pay back that $50,000 with cash flow. And then all of a sudden, as you're paying it back, the money becomes available again. And that's how it serves as your kind of your reserve account. And you're building up, again, capital for your next deal. It's pretty awesome. So here's your timeline in the strategy. Months 1 to 12 is the foundation. Fund your policy with disciplined contributions. And that's a very powerful word. This is not a get-rich-quick scheme, as you've probably figured out. There's no doggy coins that I'm sharing here, or the next, hot mining stock that's going to explode and melt your face off, just like silver's doing to the world. This is not that. This is a disciplined saving system that you're integrating with real estate. I love life insurance and real estate. I'll get to why they're very similar. They move slow. It requires discipline. And that's what I love about it. And that's what this is. So disciplined contributions. Your cash value builds while you research markets, analyze deals, and build your real estate knowledge base. The second step, months 12 to 18, your first acquisition, borrow against your policy for down payment on property number 1. Your policy continues growing while rental income begins flowing. Then the third step, months 18 to 36, system refinement. Use rental cash flow to service the policy loans, continue policy funding, identify and prepare for number 2. Step number 4, months 36 to 60, portfolio expansion, acquire properties 2 and 3 using the same strategy. It's infinite, continues to go. You make premiums, disciplined saving, you pay down the policy loans with your rental income, build up backup capital, and now you're deploying it again. Your bank has grown substantially, providing even more capital for future deals. And then step number 5, years 5 to 10, wealth acceleration. Love that term. Your system becomes self-sustaining. Properties appreciate, loans get repaid, and your bank grows exponentially. You now control a multi-million-dollar portfolio built from your initial capital. And that's the thing. You're building your flywheel. And that's why, who is this not for? That's one of your most frequently asked questions. So I'm going to save you some time at the end. If you get anxiety from waiting for something, if you don't have a long-term vision, and if you can't see the big picture, 5 to 10 years of what you're building now, how this flywheel is going to come together and just accelerate between years 5 and 10. If you cannot see that, nor have the patience, then this is not for you. If you're disciplined, if you're not into get-rich-quick schemes, and you're kind of in the get wealthy for sure business, which is the title of one of my books, then this is for you. Fast food or slow cooked homemade cooking. I prefer the latter. All right. I'm going to skip over that because there's a couple of, excuse me, numbers are a little bit off, and I want you to grasp this concept. So here's the example of the same dollar twice, the power of simultaneous jobs. So $100,000 flows into your banking policy. Capital begins compounding immediately with guaranteed growth, rates, and dividend potential. Policy continues compounding uninterrupted. Your full cash value remains intact and growing even while you deploy borrowed capital. You borrow $25,000 for a down payment. Access capital within days without loan applications using your policy or collateral. By the way, this takes about at most 48 to 72 hours. A lot of people say, well, how quickly do I get my money? It's not an ATM. You don't have a checkbook. There is, however, a strategy to get a checkbook in your hand with this strategy, but about usually 48 to 72 hours. The property produces cash flow, rental income, covers expenses, and generates monthly profit for loan repayment. Cash flow repays your policy loan. Property pays back the bank in control, recapturing interest that would have otherwise gone to lenders. You're now your own bank. You've got your own pool of money. The money's going out into properties and coming back. You have control over this whole process, which is the beauty of this. Policy value keeps growing the entire time. Okay, your original capital never stopped compounding. It simply added a second income stream. How does that sound? Uninterrupted compounding. It's incredible. It's incredible. The dollar never stops working. It just changed jobs. A lot of people talk about compounding, right? You know, they quote Einstein. What is it? The eighth wonder of the world. Yes, all that stuff's great. But just remember, in most vehicles, your fees and your taxes compound with you. There's always in most vehicles another compound interest equation or compound fee or compound taxes. You want to be on the right side of this. This puts you on the right side of it. So why this beats saving cash? Again, you don't lose the ability to earn on this money. So it compounds continuously. It grows contractually. It does multiple jobs. Controlled leverage on demand. There's another nice big word that we all love as real estate investors. The speed, it's immediate and scalable. And again, contractual guarantees and minimums is in there, and you control everything. You control everything. Down payments without delays. That's the beautiful thing about this. When the deal appears, capital is already waiting. So there's no loan apps, no credit checks, no approval process, no waiting. You have guaranteed access to a policy loan. Let me tell you another sob story of mine. I love sharing my sob stories. Anybody here remember 2008, 2009? What a fun time that was. So a lot of HELOCs was pulled. And by the way, you could have had a HELOC with Washington Mutual, which doesn't exist anymore, like I did. So these things do happen. But in the life insurance policies, not only they can't just pull this ability from you to do this. There's a contractual guarantee that you have access to a policy loan. And again, the reason why they do that, you always have to see both sides of the table, is they have two pieces of collateral of yours. They already have the cash and they have a death benefit. So even if you take a policy loan and decide not to pay them back, which is an option, it's not part of the system, eventually they will be made whole, because at some stage, you and I are going to leave this spinning ball of dirt, which we operate on not right now. All right. Your built-in property reserve account. We talked about this. This is the thing that really rug pulled me back in the day, especially in the beginning. It wasn't even big. I was trying to get big. This prohibited that. You have a maintenance reserve, vacancy buffer, CapEx fund, property tax reserve, and insurance reserves. So this is stored liquidity, not emergency cash wasting away. Remember that first slide that probably made you cringe, of money just sitting idle doing nothing and becoming worth less as inflation eats it up? This changes the game. Real estate and life insurance, they're the same asset class. Now you're probably rolling your eyes when you hear this. And the first time I figured this out, and I mean, I'm one of those guys that, yes, I have the sports background, but I can really nerd out on this stuff. I love history, economics, finance, and I love real estate. And I went on really in a deep dive down the rabbit hole in insurance. And at one stage, I was like, now I understand why they integrate these two asset classes, because it's essentially the same asset class. How is it the same? Well, let me give you a quick rundown. I mean, this could be a presentation of itself, but essentially, if you have real estate, right, and you buy it with a mortgage, down payment and a mortgage, there is a payment period on the mortgage. Let's just say 30 years before you pay it off and you own it free and clear. When you have a life insurance contract and you set up this specifically designed life insurance policies that I'm talking about, you choose your payment period. So you can have a 5-pay, 7-pay, 10, 15, 20, 30 years, or you could pay it for as long as you want. But same kind of thing. There's a certain amount of payments that you need to make until you own the policy free and clear, just like how you own the real estate free and clear when you pay off the mortgage. With every payment that you make to a mortgage, you pay principal and interest, right? So you build up equity with payments. Life insurance, exactly the same. As you're funding these premiums, with 70 to 80% of your premiums go towards cash value, the equity part, you build up equity faster in this vehicle. But yeah, you build up equity in both of these. How do you access the equity? Well, in real estate, you have a HELOC, home equity line of credit, right? You place the equity as collateral for a loan, and you do that through a bank or a financial company. With the life insurance, you access the equity through a policy loan, or you could set it up with a bank. There are situations where you would. They call it a LILOC, life insurance line of credit. If the property is a rental property and it's managed right, you bought it right, you financed it right, and you managed it right, the value of the property is going to appreciate. The same way with this life insurance policy, if it's structured correctly with the right partner and it's managed correctly, this strategy, it's the value of the contract, the death benefit contractually appreciates. Tax benefits, real estate, one of the best. It's incredible. You don't have to go to an offshore exotic island to save on taxes. Just buy real estate in the United States. It's fantastic. Same thing with life insurance. It's all money that's after taxes, right? So you pay taxes on the money when you control it and you determine how much it is. It goes into the policy. It's tax deferred, and through proper strategy, you never pay taxes on that ever again. The dividends are tax-free. You can access the money tax-free, and the death benefit is tax-free to your beneficiaries. With real estate, if it's rental, bought right, financed right, managed right, and you get at the end of the month, you pay all the bills and there's money left over. The profit is cash flow. Same thing with the real estate. With a life insurance company, where if you set it up with a mutual life insurance company that's been profitable for 170 years consecutively, you get to participate in the profit rather, and that's through dividends. That's cash flow. So the dividends is cash flow, like the real estate cash flow. You could sell a mortgage note. You could sell a life insurance contract. I could keep going on and on. You can reverse mortgage a property. You can, quote unquote, reverse mortgage for income a life insurance contract. So Very, very similar asset classes. Again, long-term by design, tax advantage, leverageable, backed by contracts, predictable if structured correctly. So why they work together, it's the perfect partnership. When insurance and real estate strategies integrate, they create something more powerful than the sum of their parts, a self-reinforcing system that accelerates wealth building while reducing risk. The insurance provides liquidity when you need it, and certainty when markets fluctuate. Again, the performance of your policy is not tied to any stock market. Your financial foundation remains unshakable. Real estate provides growth through appreciation and cash flow through operations, tangible assets that build generational wealth. So together they can create velocity of capital, the ability to deploy the same dollar multiple times, compounding returns across your entire portfolio. Real estate accelerates wealth. The bank stabilizes and multiplies it. I'm going to say this again. The real estate accelerates the wealth. The bank stabilizes and multiplies it. It's incredible how powerful the combination of these two assets are. And you don't have to choose between the one. It's, the life insurance asset class is the end asset. Money can go in there and then flow to real estate, and you integrate the two. So you don't have to choose between it. Here's the quick flywheel. You fund the policy, you get the policy loan for the down payment, you collect the rental income, you repay the policy loan, and again, it becomes available again because it is a line of credit that is revolving. So this is how you generate the velocity. A dollar moving through a system 3 times at 6% outperforms a dollar sitting still at 12. It's quite incredible. The flywheel effect transforms good returns into exceptional wealth. So what changes when you become the bank? You scale faster, you stop waiting on lenders, you keep that big word, control. You reduce risk because you control this entire process, and you build permanent infrastructure just like the ultra affluent and ultra wealthy do in their family offices. Properties come and go. Your banking system stays forever. You do this 5, 10, 15, 20, 30, 40 years into it, you're going to build up 2 asset classes. You're going to grow and scale your portfolio of real estate properties, and you have this bank, which is your family bank, and that could be a legacy piece for your family. So the question every serious investor must answer is, if you're serious about building a real estate portfolio, why wouldn't you also build the bank behind it? Think about that. Remember what I said before. Remember what I said. The bank makes money when you deposit it, whether you save, spend, or invest. If you borrow from that same bank, whether you borrow the money to save, spend, invest, the bank makes the profit. So build your real estate portfolio, but also build the bank behind it so you and your family can be the one benefiting. So a lot of traditional advisors miss this strategy completely. They don't understand real estate. They can't earn commissions on the success, and it requires a cross-disciplinary expertise. I started my company because I saw such a disconnect in financial services in the alignment of interests. Because where should you keep your money? Where you control it and you can grow and scale your real estate portfolio. That's what I try to do as a real estate investor. But for the most part in financial services, while they like to get control over your capital and grow and scale the assets under management, which is where they earn, where they make their money, right? So we started Producers Wealth, and back in it's 2015, right? So this is our 11th year. I started that because I saw the disconnect. Ready to build your own personal real estate bank. So you've seen how this works. I hope that my goal here tonight was to bring this concept to you so that you can understand just the concept of it. We can get into the weeds and the details separately. You could book a call with myself and my team at producerswealth.com/strategy. Okay, the question isn't whether the strategy works. The question is will you be among the few that implement it? So, I always get asked a question, MC, what's the one thing that moved the needle for you over the past, 25, 26 years as a real estate investor, which I still am. And this is the one thing that moved the needle. Integrating this and building out this capital engine to fund and fuel my business, my real estate portfolio. So I hope that was valuable for you guys. If you find value and if you just want to explore options for yourself, because everything is customizable, just go to producerswealth.com/strategy and book a call.
MC, thank you so much for that presentation. Folks, I just want to check in with everybody that is still here listening, was able to make it to the end, and let you know that this is your opportunity now to ask your questions directly to MC. We have him here completely live, and he is available to take your questions. I know that was a lot of information. It was probably a lot of very new and different information for folks here. So by all means, use this opportunity to ask any follow-up questions, any clarification questions, any questions about how this might apply to you individually. Anything you want to ask, go ahead and type that in the chat box or the Q&A now. While you're doing that, MC, let me just sort of ask a general question about getting started. How much would somebody need to start with this strategy? So when they could come in the door and say, I want to start this, I want to, set up my bank, how much capital should they have to do that? And then what is the process like once they go to producerswealth.com/strategy? What would they then expect as the next step for them?
Yeah, it all depends on the track that you're at, right? We all have to start somewhere. So if you are in a position now that you are in phase one, where you're like, I want to buy real estate, I'm learning, I'm trying to figure out the deals, and I'm building up capital. Well, $10,000, $15,000 a year into this, within like the next, I would say, 2 years, you're going to be able to buy that first property. You'll have enough money for the down payment, right? Then there are some folks that they are ready to rock. They're probably more 6 to 12 months, 12 to 18 months. So that could be 25 to 50K that you want to fuel it. A good rule of thumb here is that insurance carriers, again, this is kind of generalizing it, but just to give you an idea, 25% of your gross income is usually what they allow you to put in here. But I would look at your goals, and that's why, setting up a call with my team and myself, we could help you figure this out. What phase are you in? Are you buying a property 6 to 12 to 18 months from now? Is it more 18 to 24 months, 24 to 36 months? And then we could structure and build it this way so that you have enough capital when you're ready to execute.
All right. So for anybody that is watching this on the recording and is obviously not able to ask their questions live, should they just go to producerswealth.com/strategy and then they can set up, is that a free consultation where they can get their follow-up questions answered? Like, what will that process be like for them?
Yeah, that's a free consultation. We'll explore some of these options for you. But first, we'll get to learn about you and your goals and your situation, because every situation is unique, right? So every, ages is different. Income levels are different. Your timelines are different. So we want to learn more about you first and then figure out then, okay, we'll be able to help you and look at your timeline and your expectations and then kind of build a customized strategy for you. Other things to think about, Matt, if I have to think about frequently asked questions, first thing that people say, it's life insurance, right? So is there like a medical that you have to go through? Yes, you are applying for a life insurance policy. Well, what if I'm an insurable? What if I have, a medical history that is going to disqualify me for a life insurance policy? Well, if you have a spouse that's healthy, then now the life insurance policy could be on him or her, right? And then you guys can both be owners of the policy. And again, the family can be the beneficiary. So it's, again, there's three roles here. There's the insured, there's the owner, and then there's the beneficiary. So there's other options too. We can get creative. What tends to happen anyway is one spouse finds out about this strategy, sets this up, and then there's a light bulb moment. And the moment becomes, oh, wait a second. I just funded the down payment with this property, and now we're getting money already deposited in our accounts, rental income, and we're paying it down, and I'm cycling it back into my capital engine, just like MC shared in the presentation. Wait a second. I got to set up another policy for my spouse. And then children's policies too. We do those too. I eat my own cooking without getting sick too, I might add. So we have our family policies too. My wife has policies. I have policies. Our kids have policies. We have a family bank kind of structure modeled after family offices where in our trust, these policies reside, and they become the primary funding vehicle for everything that we need, whether it's my business, whether it's buying more real estate, and so forth. So you can build this up. But that's the other question. Am I too old? Am I too young? We have set up policies. This will blow your mind. We have set up, and this is kind of interesting too. The majority of our clients over the past 2 years is between ages 55 and like 68, which is like mind blowing because we never ever just like spoke to that demographic, but interesting things happen. There's huge liquidity events between 55 and 70. I'm almost there, so I'll find out soon, but I'm still a little bit younger, so I haven't thought about it yet. But looking at just for my clients and our clients, there's inheritances if you're lucky enough, right? There's businesses that get sold, other properties that you sell, profits from that, or businesses that get sold. So yeah, there's a strategy for you. Obviously, you could have a shorter payment period. If you're 60, you can have a policy paid up in 5 years. If you're 20, 21, or even 18, or if children's policies, yes, you could set those policies up too. You have a longer runway. Other frequently asked questions, I'll just hit a couple for you too, Matt, is how does this go wrong, MC? And by the way, I love to ask that question too. Every interesting like asset class or strategy that somebody shares with me, I say, okay, how does this go pear-shaped? It sounds great, but how does this go down? This does not work. Number one, this is how it can go wrong. The policy needs to be set up with the correct life insurance carrier, mutual insurance carriers. So it has to be one of the top mutuals. There's like a handful of them in the United States. There's some great ones in Canada too, but you have to, and by the way, that's the other question. It has to be in the US or Canada. Unfortunately, these strategies are not available for other folks in other parts of the world, but it has to be with the right carrier. It has to be structured correctly. So you have to set it up with the right advisor, because insurance, just like any other industry, there's a lot of nefarious characters everywhere. They're in insurance too. That's why people run at cocktail parties, from insurance folks, such as myself, But I can enjoy a drink lonely too, man, and still have a good time. Anyway, so it has to be done with the right, correct advisor. Then it has to be implemented and executed and managed properly. This system that I just showed you, it's a system. If you just strip your policy and take policy loans against it and never repay anything back, guess what? You've now put yourself on the opposite side of a compound interest equation. It's now building against you, which is the complete opposite of what you wanted to do in the first place and why you set this up, right? So that's how it goes pear-shaped. It can go pear-shaped. So I've had many folks hear me talk on podcasts and presentations, and they're like, MC, my brother-in-law works for, ABC Insurance Agency. I listened to what you're saying. I went to him. He said he could set it up, and it doesn't look anything to what you talked about. So you must be a crook. No, not everybody knows about this. Not a lot of advisors know how to set this up correctly. So that's how this goes pear-shaped. Other funds too, Matt. I'll throw one more at you. Another thing is, can I roll over money from a 401k or an IRA into this? No, you can liquidate it, but there's a taxable event. There's no way of getting around that. You cannot take your 401k and roll your 401k into this and think that you're not going to pay taxes. Anybody that tells you otherwise, run the other side, because you might have a knock on your door from a not so friendly IRS person. So you cannot do that. You can liquidate the 401k and the IRA, pay taxes on the money, and then we fund the policy. The other thing that I would also share is, somebody asked me the other day, does the life insurance own the real estate? What does that look like? No, it does not. So I've seen many presentations of people presenting this as the rich person's Roth, which, by the way, Forbes did an article on this and called it the rich person's Roth, because when you don't qualify for, IRAs and Roth IRAs anymore, this is a great place to put it, right? Because eventually you outgrow those. But no, the life insurance does not own the real estate. The life insurance is a separate entity. The money comes out of the policy through a policy loan. You don't touch the cash inside of it, and then you buy the real estate. The real estate isn't inside of an IRA or a Roth IRA. So you get both maximum benefits from the real estate and maximum benefits from the life insurance. So that's the beauty of this. But anyway, let me pause there quick for a second and see if that opened up any other questions. Those are just a quick, frequently asked questions that I get all the time when I talk to real estate investors.
I appreciate you going through those, MC, and we are hitting the top of the hour now. So for anybody that was on the webinar or anybody that is watching this recording and didn't get your questions answered, you can go to producerswealth.com/strategy and get your completely free consultation where you can talk much more specifically about your individual situation, your personal strategy and wealth building goals, and have a conversation with MC's team over there. So with that, MC, I want to thank you so much for being here tonight and sharing all of this with us.
Thank you so much for having me, Matt. I really appreciate you and appreciate your community, and look forward to having conversations with community members.
All right. Good night, everybody.